Hello there, Michael Wall again. We're joined by Nick Geraci, our private tax director on the Invest Well show. That's a little segment, and we're talking again about the idea of selling your business. We want to talk in this segment about the idea of what is the difference between an asset sale and a stock sale. This is something that's so important, and it's something that you really need to think about. This is a one-time decision, oftentimes. Now, it can be negotiated along the way, and sometimes maybe one might seem more appealing than the other, but how you structure it really matters, not only just with what you end up receiving as far as value, how it can flow through on your taxes and all that goes with that. Nick, this is such a big deal that unfortunately, when people sell companies, a lot of times they might be a smaller business. It's not something that they're doing every day.
No.
And so they've been kind of trusting in maybe their CPA over the years or other people that have helped them along the way, maybe a bookkeeper or something like that. But these folks often are not, just because they might be in this space, doesn't mean that they are knowledgeable on really maximizing this exit. It's so important. Just because somebody's a doctor doesn't mean it's the specialist that I want to be going and trusting my life with, so to speak. So let's talk about this type of sale, the two differences, and why this is so important.
Absolutely. Selling a company is a very specialized skill. You need to go out of your way to learn the different rules, the different positioning, the entity optimization that goes along with selling the company. Again, because if you don't do that, you're not going to know the information. You're not going to know what your after-tax proceeds are going to look like. So the biggest question almost the immediate question you get when someone is selling their company is stock versus asset sale. So I'd like to spend a little bit of time just talking high level about what each of those things mean, right? So with a stock sale, typically what they're buying is the interest in the LLC or the stock of the company. This is generally, I'm going to say generally, where the seller wants to be on a stock sale side. You get capital gains treatment, long-term capital gains tax better than ordinary income tax rates. But on the other side of that coin, the buyers don't like the stock sale. And the reason behind that is you're purchasing the liabilities, you're purchasing the whole company that goes along with that from all time. The buyers are looking for more of an asset sale, right? The asset sales, you're purchasing the assets of the company, whether it be the equipment, the PP&E, whatever it might be. They're only buying that and they're leaving the shell alone. So there's kind of a push and pull relationship between buyers and sellers. And in order to, really have the ground to stand on to make a negotiation with a potential buyer, you need to know the tax consequences of both. And with correct pre-planning procedures and with enough time in advance, there are special elections you can make, whether it be through reorganizations or a 338H10 election where you get asset sale treatment for one party and stock sale treatment for another. But again, these are not decisions that you can make 24 hours after you get an LOI. These are the things that you need to know beforehand, which is also why it's so important to do those pre-sale valuations and doing the work ahead of time.
Yeah, I think it's so important to talk about the fact that we mentioned in another segment here, the idea of preparing in advance for the sale. Again, I've said it before. You've heard me say it. Nick, you've said it lots over the years. Our team, in many ways, Wall Private Wealth, Wall Private Tax, et cetera, has talked about this. Like these folks, as you've built a business, have spent years and years and years developing a company. You spent years and years developing a company, and now you're in a place where you're kind of running by the seat of your pants when you sell it. Doesn't make sense. We need to make sure that we slow down, pay attention. Because again, what might seem appealing, whether it be asset or stock type sale to you initially, may not be the best for you long term. And so we really need to dive in. Are there any other things that are differences there that we want to kind of highlight in those two?
Well, it really comes down to, what the business is really, right? There's entity optimization, things that you can go through and which will make sense for one company that won't make sense for another, which again is why it's so important to have experience across the board in this specific discipline, which, selling the company. Sometimes a stock sale, a lot of the time stock sale looks the best for the seller, but it doesn't always end up that way. So if you're getting generalized advice on what letter of intent you should accept if you got multiple on the table, the odds are you're leaving money on the table and it's a missed opportunity to maximize your after-tax proceeds.
Yeah, I think that's important. Listen, you spent a lot of time building the company that you have. The last thing that you want to do is exit wrong. A great way to exit right is get a second opinion on what you're doing. That's one of the reasons we got several companies that we've put together over the years for 25 or so years, early 2000s. We've been helping families, wealthy families all over America sell companies, protect their wealth, save millions and millions and millions in taxes, and really create complete comprehensive planning in all aspects. So connect with the sponsors of the show, Wall Private Wealth. There's literally links here where you can reach out to us, have a quick phone call, just talk about your situation and see how our team can come alongside to add value to you so you can exit well. Remember, you only exit once. Hopefully, you want to exit well. Be blessed. Talk to you next one.